Hey guys, welcome to the podcast. I've got David Snyder here from New York City. He's the founder and CEO of Harness, and he is an expert in scaling businesses from pre-launch to millions of revenue. He's going to talk to us all about entrepreneurship, scaling a company, and it's going to be a great podcast for those interested in entrepreneurship, business, and scaling a company. David, welcome.
Thank you. Great to be here. And we may even throw in some tax, which is the core of what we do at Harness now as well.
Yeah. Briefly introduce yourself, and I'm excited to dive into the questions for the audience.
Thanks for having me. I think, what made me excited about this podcast in particular is I've spent the last 12 plus years building software to help make advisors more effective in working with their clients, as many of the folks listening to the show may be. I started my career in more traditional professional services. I worked at Bain and Company Consulting with some Fortune 50 businesses, and then moved over to Bain Capital on the private equity side and got really interested in finding ways that those raw skills could be translated into more impactful entrepreneurship. And so during business school, got connected to a couple guys who I'd known for, one of whom I'd known for a long time, and helped to build Compass, the tech-enabled real estate brokerage, which is now the largest platform for residential real estate advisors in the country. Was there for half a decade as the COO, CFO, helped raise $350 million, built the business to north of $400 million in revenue. It's now north of $6 billion, and left a number of years ago to launch another business around a similar theme, which is Harness, which is a marketplace for individual small business owners to find exceptional tax, financial, and trust and estate advisors. And on the tax side, we've actually built our own proprietary experience because we felt like the best tax advisors, at least competitive prices, tended to have abysmal digital experiences. And so we've invested in not just marketplace technology, but vertical SaaS to help create a uniquely seamless and insightful tax experience for business owners and individuals with some tax complexity to navigate.
That's a beautiful introduction. And what I really love is when I hear the words platform and SaaS, you're designing really great systems to build and scale a company. And talk about the first thing is you scale startups to billion-dollar valuations. And what strategies did you use to grow Compass from pre-revenue to a 1.8 billion valuation?
I think the most important is figuring out how you can drive differential value to your clients. So when we started Compass, which initially was called Urban Compass, we were focused on a service model that would disrupt the traditional real estate agent. We were going to have a salaried person to show homes, et cetera. And we got some scale doing that, was able to raise a lot of capital, but realized pretty quickly it wasn't quite fitting. Like it wasn't exactly what the market needed, and realized that rather than trying to disrupt the real estate agent, which at least the really good ones had clients that loved working with them, it was actually the traditional real estate brokerage that was taking a third of the 80 billion industry's economics without creating a ton of value. And that evolution, pivot, if you will, really is what helped the company differentiate itself and become the leader in that space. And I think we've tried to do the same thing in the tax ecosystem, where we said, hey, we don't need to throw out all the great advisors just because their digital experiences are weak. Let's partner with the best independent and potential breakaway entrepreneurially inclined tax advisors and give them the tools to deliver an experience maybe as good as the big four, but at 1/10 the price for their clients.
Yeah, I really love this disruptive innovators, the work that you're doing. And, from what you've done in different industries, and you mentioned tax planning and you're talking about democratizing sophisticated planning. So how is Harness Wealth making advanced tax strategies accessible to the average person?
Well, the challenge in the industry is more and more really good advisors either are hard to find, retiring, or worked for firms that are increasing their pricing significantly. And so part of the key is, how do we deliver tax insights, and where just the insight is enough, do that for free, build trust with our clients. We just put out an incredibly comprehensive end of year tax planning document that lives on the harnesswealth.com blog, where we can help someone for an hour create value and understanding equity they may have or a specific complexity. We do that for a couple $100 in a way that no other firm is willing to engage and to do. And for those clients that really do have the complexity, they've got K1s, they're thinking about which expenses can deduct from income, or what the right entity structure is, or how to think about ownership structures to pass on a business to another family member. Those things require ongoing complex advisory work, and having, again, all the resources of the big firm delivered through these boutique entrepreneurial advisors allows them to charge a fraction of the pricing of what you get working with a top 10 firm. And so that arbitrage of talent and us providing a scalable tech-driven platform for them to utilize, we found has unlocked a tremendous amount of value for thousands of clients.
The next question I have for you is talking about future of the wealth management industry. And because what I get from the gist of this conversation is everything is very cumbersome, it's very inefficient, it's very expensive, and there's just a lot of middlemen, and just we could make it in only the kind of the privileged few have access. So how do you see, what is your perspective on how wealth management and will evolve in the next 10 years? If you want to mention how the blockchain or how AI is going to play into it, curious to hear your thoughts.
Yeah, and even before we get to that most recent phase of potential innovation, I think with wealth management, there's long been a view that the fees were super high, robo-advisors were going to eat the entire market. I think they've obviously been successful. Some of the larger players like Vanguard have created great robo-style offerings. But ultimately, people still care a lot about human advice and feeling like there's someone to help coach, guide, understand, and ensure that they're making the right decisions. What has happened is historically, the investment products were quite expensive, 1%, 2%, 3% fees, in addition to the advisory fees, such that you had this massive drag on your returns because of all these subcomponents you talked about, intermediaries and components. A lot of that has materially come down in pricing, and good financial advisors have been able to maintain 75, 100 basis point type fees, but only if they're doing a lot more than picking fixed income and an equity fund, et cetera, for you. They've got to be delivering value in financial planning and helping ensure you got the right asset allocation and tax deferred accounts versus not. Help a client think through not just a Roth conversion, but a mega backdoor Roth move, to make sure that clients, when they start thinking about charitable giving, are using donor advised funds and appreciated securities, of when it makes sense to create trust structures or think about residency nuances. And so the advisors that are creating that more comprehensive experience, in our view, ones that even extend that to having great tax partners, and we partner with a ton of really effective financial advisory firms, both big and small, those are the ones that can justify their fees and generate a ton more value for the clients than they're charging. I think, sure, when Bitcoin's at 99,000, you're going to get advisors that want to introduce alternative assets into their crypto assets, into the portfolios of their clients. There's definitely way more alternative investments. So like, we're hosting a webinar in a couple of weeks with someone from the world's leading fractional multi-million-dollar contemporary art platform, Masterworks, from a business that's focused on being able to invest in farmland, even at $100,000, where it used to be, whatever, 10 million if you weren't actually a farmer in those areas. A firm called Bridge that does fractional private equity investment. So there's way more access to more complex investment products that, as long as they match people's time horizon, can be super valuable. But they also create incremental complexity, capital call management, and K1s at tax time and stuff like that. So it's important to ensure for those that are intrigued by them that they understand the downstream implications.
Yeah, when the company that comes to mind when you were talking about kind of the fees was, I think Robinhood was the one to just slash all the, and basically, force like Fidelity and TD Ameritrade and Charles Schwab, all these brokers, to basically cut their commissions to zero. Otherwise, they lose all their business. And what are your thoughts on, because you talked about fractionalized ownership of just assets traditionally for the accredited investors, but democratizing it. What are your thoughts on, because Larry Fink talks about this a lot, is tokenizing real world assets on the blockchain, like, for example, like real estate or fine art. What are your thoughts?
Well, I think for large institutions like a BlackRock, anything that creates decreased friction to, I'll call it subscale, it's really hard to deal with the paperwork, the tracking of certain private equity assets, other things. And the more that there can be a ledger to understand ownership and help with those things, institutionally, it allows really large players to play in those spaces. I think for the individual entrepreneur, high net worth individual, personally, I don't think it ends up making a big difference in terms of your outcomes. I think there's much broader value in being focused on what are asset classes that you have an interest in, expertise in, how can you diversify, how can you keep the fees of having that diversification low, and are there places where less liquid alternative assets with more complexity create more value ultimately. And I was having a conversation at our company team lunch today about the asset class of URLs. As crazy as it sounds, there is a very active market among especially high net worth, ultra high net worth tech folks buying URLs. Used to be just .coms had value. Now it's .cos, it's .ai, et cetera. And so I think that's an area where people that were of a space felt like, hey, this is a different non-correlated asset that makes sense for you to invest. That's created a lot of alpha. I think the tokenization of assets is interesting and helps institutionally allow for more opportunities and lower operating costs. But personally, I don't think it makes as big a difference for the individual in the asset class where it was obviously most important because it was about that. NFTs, that's a market that really has gone through a massive boom and bust cycle. And I think there's still value in some of those, but it has been challenging for anyone who put a lot of money and energy into that during its peak period a couple of years ago.
Yeah, I was just gonna ask you about NFTs because the previous guest was talking about sports entertainment. A follow-up question I have for you is because I had another guest talk about how it was like the traditional, like the people that old money, they put all their money in real estate or fine art. And now like the new money, the millennials and the Gen Z that are making their money through Bitcoin or crypto, they view real estate as this old ancient asset. What are your thoughts? Just are there newer, better ways of investing for the younger generation, or is still like real estate still a sound? Is it still a good investment? Just talk about the pros and cons.
Sure. Yeah. I think at a high level, to answer your question, the old adage is probably still true that people generally make significant wealth through concentration. And that can be generally it's a concentrated bet in your own day-to-day business, whether it's a medical practice that you own, a small business, a venture-backed startup, et cetera. And then you retain through diversification because there's obviously way more volatility in single assets. Real estate has a lot of favorable attributes from a tax perspective and from, in many cases, a scarcity perspective that I think gives it enduring value. I think in general, it's hard to feel confident in having all of your assets once you amassed a decent amount in one particular place. But the beauty of real estate is that you can get effective leverage on your investment. So through mortgages, debt financing, et cetera, you're able to get higher return than just the underlying cash flow of investment if you put all of it up front in a way that you can in some other classes, asset classes, margin lending, et cetera, but generally not to the same extent. A lot of the investments that you make in it are deductible. And more importantly, there's some ways that you can accelerate depreciation or make investments and manage the tax burden of those investments really effectively. And so one of the reasons that people have liked the asset class is because you can amass value and cash flow while offsetting a lot of the taxes that you would have to pay along the way. And then you can use maneuvers like a 1031 exchange where a property that you have that you want to sell can actually be exchanged for another property where you don't incur capital gains taxes in that transition. And so because of its nature of being The safety of it varies obviously in the location and the quality of the asset, but broadly speaking, a bit more stable, leverageable, to some extent tax deductible, I think gives it an enduring value in most markets. Now, that being said, if you're buying in really frothy environments or you're buying speculatively in places where there's not clear demand for the real estate, that's how you end up with a 2008 situation where you've got real estate assets, but no one that wants to utilize them and there's no yield and they can get foreclosed on. But in general, I think real estate has an important in lots of people's portfolios.
Which brings me to this new area of DeFi, like decentralized finance, and because now like Bitcoin and Ether are considered commodities. And do you think in the future there's going to be a company or a startup that allows individuals to borrow against their Bitcoin, like Bitcoin as a tangible hard asset, and they can borrow against it safely? Because I know, for example, 2 years ago, a couple of companies tried to do that and they went bust. But do you think eventually crypto assets will be on a similar scale if they do this tokenized blockchain project?
Even without that, I think some of the mainstream players like Coinbase allow you to use margin. And I haven't checked in on it lately, but I would be surprised if some of the more forward-looking asset custodians like Fidelity don't allow it soon. So yeah, I think, it was before the recent run up $3 trillion plus asset class. And so I think there's tremendous perceived and real value in it that allows people to borrow against it. I think what's important for folks to recognize is if you look at that chart, Bitcoin has moved from hundreds of dollars to tens of thousands of dollars to single digit thousands to tens of thousands in a matter of half a decade, basically, or maybe a full decade. And so if you're contemplating one of the safest assets you can use to create leverage, the danger of it is, yes, you can borrow against it, but if the value drops precipitously, usually you're going to experience some type of capital call from whoever is lending you dollars against it. And so in general, you want to avoid long-term borrowing against volatile asset classes because it can create a real pinch for people. So yes, I do think it is possible today to borrow against at least the mainstream crypto assets. Whether that is the most prudent thing to do really depends on someone's individual situation and what they're using that additional capital for.
Really insightful. And so round it out, because you've had really, really fantastic career and just really love the work that you're doing with just the leveraging technology in these different industries. If people are inspired, talk about just learning from entrepreneurial setbacks and just keep going. And then how can people find out more about you and the fantastic work that you and your company are doing?
I appreciate that. Yeah. There's some entrepreneurs that you meet in the venture-backed ecosystem and say, oh yeah, I have a few conversations every time I need to raise 10 million bucks or 100 million bucks. And it takes a week. I think that has not been my lived experience of, I think at this point now over 1,000 meetings across the 10 rounds of capital and 400 million plus that I've raised across these two businesses. It's a grind. And I think that learning how to effectively articulate the narrative of your business and learn from the investor conversations, but not get disappointed by what for 99+% of us is a lot more rejections than term sheets in dollars is a really important skill and value. I think as it relates to people that are looking for tax guidance or maybe financial advisor, principally tax, harnesswealth.com is the business that we've built to help entrepreneurs navigate complexity effectively. And I think a lot of the stuff we've talked about, when the dollars that are at play matter, it's really useful to have the right guidance. Even on crypto, like we're just talking about, there's a ton of nuance in the way that you think about the taxation of it. Do you use a first in, first out methodology or last in, first out? And the seemingly banal topic can be massive for someone who owns 10 Bitcoin and has bought them over the last 5 years and thinking about how not to owe hundreds of thousands of dollars in taxes when they do it. I would highly recommend people that are thinking about increasing the complexity of their portfolio to ensure that you've got the right advice around what the downstream implications, especially for tax, might be of some of these things that look sexy outright and can be super additive in your portfolio, but may also add some complexity to the way that you think about your financial life further down the road.
Yeah, no, once you oh, the capital gains is awesome, but once that tax bill hits, it's, oh my God, you have another problem.
No one's withholding for you across most of these things that we just talked about. So
Yeah.
important to know what you're getting yourself into.
Yeah, that's called the high quality problem. So,
Yes.
but thanks so much. And I really enjoyed this conversation, and keep up the great work.
I really appreciate it. Thanks for having me.